Welcome back to the continuing lecture series in investments, investment analysis. And this is Dr. Jeff Hong, and this is the eighth video in the same topic. Now, so in our last video, we discussed, how yield to maturity is the same concept as continuous growth rate, or continuous realized return. When all the interest or the coupon payment, all the coupon payments are reinvested at the same coupon rate. But again, there's no guarantee that your reinvestment rate would be the same as the original coupon interest rate. Now, and in this video, we're going to be talking about the holding period return. Okay? Now, it's not difficult to understand the holding period return, because holding period return is the total return over the entire holding period of the asset, right? So let's go back a few slides. Okay, because I just want to use a blank space. So that's why I moved a few slides back. So if I were to define holding period return, and this is something you have already holding period. This is something you have already learned in Finance 100, especially if you took 100 with me. So think about it. If the holding period is between time t and t minus n, in other words, time t minus n is the time when you invested in this asset. Okay, and let n be 10. That means and 10 periods or 10 years, right? So if this year is 2019, end of 2019, right? The 10 years ago was 2009, right? End of 2009, which is the same thing as the beginning of year 2010. Actually, from year, so suppose you're selling off this asset at the end of 2019, but you don't have to actually sell it. We can just imagine that you're selling it at the end of 2010, and then the price, I mean the price at time t, that's the price at 2000 end of 2019, and you must subtract price at time t minus n. Okay, and then that's what? That's the appreciation of asset price during this n-year holding period, right? Which is also called capital gains, right? And then during these n years, you have You have incidental incomes, such investment, in other words, investment income, such as in interest, coupon interest, or dividends. So I'll call it cash flow, right? Uh, all the invest cash flows or income during this time period, and which where the t runs from 1 through n, okay, from the first period. And then you divide it. So think about it. Price at time t minus 1 is your initial investment, right? And the price at time t is your final, or terminal value of your investment. So therefore, I'm going to have to erase this. Therefore, this is called capital gains. Okay, capital gains, right? So this is holding period return. And then based on that concept, now let's think about let's take a look at this example. So a bond was issued n years ago when yield was 7%. So this is the prevailing rate, prevailing market rate, or discount rate, right? Discount rate, or prevailing market rate. I'm not gonna. And it was coupon rate. This is coupon rate. Coupon rate was set at 7% with annual coupon. So they were not paying, semi-annual, but annual, right? So that means, think about it. If the coupon rate is also 7%, what can you tell? What was the selling price? Huh? That was N years ago, but at the time when it was sold, coupon rate was same as the discount rate. What can you tell about the price of this bond? In other words, at the time, how much was the bond priced? In other words, the question is, was that a premium bond or was that a discount bond? Or otherwise? And if you have been following this lecture very closely, you would easily tell, oh, the bond was neither, at the time it was selling, was neither premium bond or discount bond. Why? Because the coupon rate was same as the discount rate. So then the bond was selling at what? Par value, right? This was selling at par value, right? This was selling at the par value of $1,000, right? At the time, when it was, N years ago. Now, with 3 years left in the bond's life, okay, so now maturity left, time left to maturity is 3 years. Now, discount rate is 8%. From this, you can already tell, is this going to be a discount bond or premium bond? Well, you should be able to tell it's a discount bond because now the discount rate is higher than the coupon rate, right? So with 3 years left, so if we price the bond, and I'm not going to go through the formula because this is Uh, this is already, something you should automatically know. Um, so this is just the way the book simplified it. So this is basically, present value of annuity, right? This is basically present value of annuity part, right? Coupon times. Okay, present value of annuity part. And this is the present value of the par value or the maturity value, right? Present value of the maturity value, right? Or redemption value, right? There are several names for the maturity value, right? It's called maturity value or face value or the future value or the par value or redemption value. So there are at least 5 names, okay? So if you do that, it comes to less than par value, so it's the discount bond. And so with 3 years left, now this is the bond price, but at time t plus 1, that means 1 year after, which means with 2 years left, right? With 2 years left, then after coupon has been paid, maturity falls to 2 years. Then price will be then once again. If you calculate this, it will the price will be 982. Again, this is still discount bond, and in this example, actually the bond price slightly went up. I mean, bond price went up, not just slightly. It went up by 7.94. And think about it. Remember, I said the bonds will always be 1,000. Bond price will always be $1,000 at maturity because that's the par value of the bond. That's what you redeem, right? So depending on the depending on whether it's a premium bond or discount bond, it will be whether it is the pattern of and I believe did we see that pattern before? I think here, yeah, the pattern of the bond price movement looks like this, because at maturity, because it's maturity, it will be always par value, right, or maturity value. But because it's premium bond, the farther away from maturity, the premium bond has the price is higher, right? Because it's premium bond. But as it nears the maturity, I should actually, it shows this pattern, right? The price of the bond goes down as it reaches maturity. In case of discount bond, as you approach maturity, right? Because it started from a deep discount, deep or slight discount, depending on the, the difference between the coupon rate and the discount rate, right? Yield. You understand this pattern. It will show upsloping pattern, and the premium bond will show downsloping pattern, right? And it is clearly, shown here. This was a discount bond. So as you approach maturity, right, the price goes up, and there's going to be a capital gain of, right, $7.94, right? And during this 1 year, right, between this is t minus 3, right, year t minus 3, right, not that t, terminal t, I'm sorry. Maturity is always, uppercase, terminal time. And this is t minus 2 from maturity, only 2 years before maturity, right? So between t minus 3 and t minus 2 is 1 year, right? During this time, the 8% coupon, 7% coupon, $70. So this is the interest during that time, right? And capital gains. In other words, this is sum of all the cash flows. Oops, I'm sorry. It's hard to so this is like, sum of the cash flow during that 1 year period and plus capital gains. During that 1 year period. Capital gains, right? Oh, okay. Now this one doesn't look like, okay. Okay, so you see this is the numerator in this formula, right? Numerator in this formula, just for 1 year, right? And then so we, if you want to calculate the 1 year holding period, right? If you were holding it for just 1 year, then you divide it by whatever you, so this, if you bought this bond in 3 years before the maturity, right, at time t minus 1, t minus 3, and you sold it at the end of time t minus 2, during this 1 year period, right, you divide it by price, which is, at time t minus 3, which is your initial investment, right? Then what is it? It's going to be, actually, it will come out exactly as 8%. Okay. But, this is only, mathematics constructed that way. And because as I said, if the yield is 8%, what does that mean? That's the discount rate that will make the left-hand side of the equation. Left-hand side of the equation is, if I solve this for price of, if I solve this equation for P sub t minus 2, then you will get exactly 8%. So we use the discount rate, which is internal rate of return. So obviously, if you solve it for rate, you would get exactly internal rate of return. Okay, so now that's the holding period return. Now let's take a look at another example. If we can use, uh, if we can predict, our we can predict our, holding period return. Um, I mean, and then we can also uh, find a way to maximize our uh, holding period return or total return. Now, suppose, and especially, in the previous example, the prevailing market rate was constant. But now let's think about the case where prevailing market rate changes. And uh, interest rate changes are pretty much well predicted because Federal Reserve always provides guidance, meaning, Federal Reserve will, after every FOMC meeting, right? They hold press conference, and in the press conference, they will tell you, um, they will tell the entire, world what policy action they're going to take. Okay, so that's called guidance. So let's say you anticipate long-term yield, long-term interest rate to drop from 6% to 5% during next year. If yield change or discount rate or interest rate changes, right? What will be the total return for 20-year 6.5% coupon bond? Now, first thing, this is coupon interest rate, right? And even as of today, which one is greater? Is coupon rate greater or the yield greater? The coupon rate is greater, isn't it right? Coupon rate is 6.5%. The yield at time t now, right, is 6%, right? Is 6%. So what can you tell about this bond? This bond will be a premium bond or discount bond. Of course, it's going to be a premium bond, right? Because it's greater than coupon rate is greater. So let's find the bond price at time t. Now it's actually rather than PT, it should be BT, but that's what the textbook was using. Textbook was that's fine. We'll just label it again as BT. So bond price at time t. Something very nice. Bond price at time t, and using the bond valuation formula, right? We know bond coupon payment, and it's semi-annual, right? Previous one was annual. It's normally assumed semi-annual, right? It's always semi-annual. Semi-annual. And this part is just a tweaking of, I normally use what? Coupon payment or right, minus coupon payment over R times 1 plus R raised to N, right? For the annuity part, right? Plus, maturity value, right? Over 1 plus R. Raised to N. Now you understand why I don't use Y here, because again yield is annual, okay? always, all interest rates are expressed as annual. So this, but this has to be a half-year rate, right? This is because bond is on a semi-annual cycle. So that's why I don't use the symbol Y in here, because then because R is periodic rate. So regardless of what the periodic compounding frequency is, in other words, M, regardless of what M is, R would always reflect, it would refer to the periodic rate, so rate adjusted for compounding frequency. Now, but think about it. If you factor out the common factor, if you factor out payment, right? And then if you factor out the payment and if you rearrange everything, factor out the payment, right? Rearrange everything. This is just the way they did, rearrange. So, and that's not very nice. I mean, if you rearrange it, it should be, less complicated than this. But anyway, so then half-year rate is what? Half-year coupon rate is now annual. Half-year yield is 3% because the annual yield is 6% now, but it will be 5% 5 next year. So that's why 0.03 raised to 40. Why 40? Because 20 years are left, and that means 40 semesters, right? So then if you calculate it, it comes to 1,075. And the price next year, if we calculate the price next year, we know that the price will be, discount rate will go down to, yield will go down to 5.5. But coupon rate is always fixed, right? Coupon rate is fixed, and half of 5.5% annual rate would be 2.75%, which is 0.02, and then 275, and then it will be next year. And next year you have only 1 year later, so 19 years left. Next year, only 19, then 19 years left to maturity. So that will be 38 semesters, right? It's going to be 38 semesters, right? $19 years, which is 38 semesters. So if you do that, it comes to 116 and 97. So what do you see here? What do you see here? Was there actually, you see capital gains in this case. Capital gains. But you might wonder, didn't I say if it is a premium bond, right, over the life of the bond, there will be a decline in the capital price, right? And if it is a discount bond, there will be, capital gains increasing. But this is premium bond. Shouldn't there be capital loss? Why well, there's capital. There will be, in this case, think about it. The prevailing market rate has changed, right? If the discount rate or the interest rate remained at 6%, of course, then there will be capital loss. But then the discount rate has gone down. So even though there are only, 4 coupon payments left, right? 2 less than the at time t, right? It will still be there will still be a capital gains because of right, because of the lower, discount rate, right? Since, or this means, since or because of decrease in yield. Oops. And then, so there was a capital gains, and then during this 1 year period, there was coupon payment of $65. So total cash flow or proceeds from this bond, if you sold this bond, then, after, time t plus 1, it's going to be, so this is total, numerator part, right? Numerator in the holding period return formula, right? Okay, in this formula, let's see if I can copy this. Yeah, I can copy. Okay. So what you're seeing is, in this case, right, you have cash flow of $65 and capital gains of 59 point, right? And then the initial investment was like, a price at time terminal T minus 20, right? Okay, so this is the numerator part, right? This is the right, this numerator part, and this is the denominator part. Okay. So this way, your total return or holding period return is 11.74. So in a way, thanks to the Federal Reserve's guidance, right? You can, if you can predict the interest rate change ahead of time, you can maximize your holding period return. All right, that's it for this video, this segment of the video. Time's up, so I'll have to cut the video and see you in the next video. Thanks for watching.